Hello, everyone. Welcome to the show Ultimate Market Insights, the show in which we cut the clutter, the noise related to markets, and bring to you some interesting insights which helps you make better investment decisions and make more profit from your investments. I'm Dr. Mukesh Jindal, and I work as partner with Alpha Capital. Today in this show, I'm going to tell you 5 interesting stories related to the market, what has been happening in the past, and how does the future looks like. Now, before I share those stories with you, disclaimer as usual, whatever information which I'm going to share in this show are the views of Alpha Capital. These are expectations, the expectations which may or may not play out. So it's suggested that you do your due diligence before making any investments. Talking about the 5 stories which I have for today, which I want to show you, it's important that I tell you what has happened in the last 1 month. 1 month has been a phenomenal time for the markets. The Indian equity has gone up by around 9%. The US market, the tech stocks, they all have done very well. This is despite the US Fed hiking the rates by 0.75% and RBI expected to hike the rates on 5th August by 0.5%. In fact, I have been getting a lot of messages, a lot of calls from my clients that what's happening in the market. There was so much of negativity around. There was Ukraine war, the interest rates are going up. Then why has suddenly market started going up? So let me explain you what has been happening in the market. So before I tell you why did this play out, it's important to understand that why market has been correcting since October 2021. We all know that inflation has been a big problem, and to control the inflation, the US Fed has been hiking the rates. Now, when the rate gets hiked, the cost of the money goes up. And when the cost of the money goes up, the liquidity in the economy comes down. The hot money flies away. It flies to safe haven like US. And that's what was happening. The money, the FIs have been pulling out from the Indian markets and other emerging markets. In fact, FIs have withdrawn almost $30 billion since October. So that's why the market has been correcting. Now, as explained in my previous video, we talked about inflation and when will this inflation problem come down. I had told that inflation is normally a self-correcting problem. It's a self-correcting problem because, when things become expensive, when inflation is high, people reduce their consumption. And when the consumption is reduced, the demand comes down and the price automatically comes down. So if you look at the commodity prices in the last 1.5 months has corrected significantly. There has been a drop of almost 30 to 40% in the agriculture commodities and industrial commodities. Even the crude has been down. It has fallen from almost like 125 to 130. And from that levels, it has come down to $105 per Brent crude. So we have seen a lot of commodity prices coming down because market is now expecting a slowdown. In fact, US also released the GDP data. And in Q2 of this year, the GDP of the US fell by 0.9%. And there was 2 consecutive quarters of negative growth. So normally, with all the slowdown, with inflation expected to come down, now market is expecting that with this kind of negativity, the US Fed is not going to hike the rates very aggressively in the coming months. So that's what market is celebrating. The FIs are coming back. In fact, in July, they bought $1 billion of Indian equity. Let's hope the party continues and we end up making good returns in the portfolio. So today, let's come to the 5 charts. I'm going to share some interesting slides with you. Now, the first chart which I have for you is very interesting. It's a research from Fidelity. And Fidelity talks about the growth forecast for next 20 years. The expected GDP growth in US dollar for next 20 years. Now, one thing what is important is that as per Fidelity, the last 20 years, the global real GDP grew at 2.7%. And it is forecasting that in the next 20 years, the growth is going to be less at 2%, which means we are going to grow less in the coming years. Now, I have some fantastic news for you. If you look at this chart, at the top, we have India. India is expected to grow at 5%. This is in US dollars. And this bullet, it shows that what was the growth in the previous 20 years. So of course, in the previous 20 years, even India had a higher growth. The growth is definitely slowing down. but 5% at the at the growth rate of 5%, India is still going to be the fastest growing economy in the world. So I think that's a fantastic news for all of us. If you look at China, China is expected to grow at around 3%, and US is expected to grow at around 2%. I think this is a very, very powerful chart because it tells us that next 20 years where the growth is going to come, where the corporate earnings are going to strong, and it's also a reflection that where the stock market is expected to do well. So if you believe in the story of India, if you feel that India is going to be the top growing economy, then I think equity is the place. Equity is going to give phenomenal return. And since most of our investors have majority of the money invested in Indian equities, I think this decade or next 20 years belongs to India, and equity definitely looks very promising. The second chart which I have, is about the US GDP growth. And this is a quarterly growth, and which I spoke about a few minutes back. In fact, the Q2 growth was negative at minus 9%, and in Q1 the US economy grew by minus 1.6%. So there have been two consecutive quarters of negative growth, which is an indication of recession. And this is the reason why market is celebrating. Market feels that Fed is going to go slow on the US interest rates hike. And I think that's a very good news for the Indian markets and the global markets. So sometimes, negative growth of GDP is also good news. But I hope it doesn't go for longer because, of course, US is a global growth engine. I hope at some point of time, the economy bounces back. The third chart which I have is, about deglobalization due to geopolitical risk. So lately, what has happened is that, globally, the economies are not cooperating so much. We have the Ukraine-Russia war, we have the China and the American crisis, we have China-India crisis. The trade is coming down. So, if you look at this, globalization chart, if you look at, from 1964 to almost 2006, there was a huge increase in globalization. And globalization, the definition is global import divided by GDP. So economies were cooperating among themselves, but since 2009, the global trade is coming down. Now, it has many implications for the investments and even, our daily consumptions and use. One, I think this deglobalization is inflationary, because if you're not able to import the good from different countries, then the prices of the good goes up. So, for example, in the last many years, China has been exporting goods, to different countries, and which kept the prices low. And now with the trades getting reduced, the prices of the goods will be going up. So inflation, yes, it may stay high because of this. Second is that, because of globalization, what was happening is that globally the markets were getting highly correlated. So, for example, if you talk about the US market, almost 40 to 50% of the the GDP growth comes from the global trade. The companies over there which are listed, they get almost 40 to 50% of the sales revenue from countries outside India, outside the US. So, for example, the Apple iPhone, it's not just selling in the US, it's selling in India, China, everywhere. Now, with the globalization coming down, that global trade will come down. And which also means that, the correlation among different economies, different markets will come down. But yes, it creates an opportunity. We can invest in different markets and try to take advantage of those situations. So this is something which is going to play out in the coming years. Now, this is an interesting chart. This talks about, the correlation of real estate, stocks, bonds with inflation. Now, inflation has been going up in 2022, and now inflation is expected to come down from September, October onwards. Now, people have been confused in this inflationary period. Where should they be putting money? Whether they should be putting money in real estate or stocks or bonds. So this is an interesting chart, and this is based on the US data, and it's a data from 1928 to 2021. Now, it shows that if you look at this table, when inflation is rising, then housing definitely does well because it gives a positive return. But stock market gives return of around 7.1%. So in a rising inflation, yes, housing does well, but stock doesn't give great return, but it's still higher than the real estate. And this was a situation which was playing out in the last few months. And if inflation starts falling down, and this is the scenario which is expected to play out, the stock market is expected to do phenomenally well. So stocks give very good return when inflation fall, and housing doesn't do so well. Even bonds, they do well in a scenario when inflation is falling. The second table shows that what's the implication if inflation is greater than 3% and inflation is rising. It shows that almost all the three investments give similar return when the inflation is high and the inflation continues to go up. And when inflation is less than 3% and inflation is falling, then of course stock does pretty well. I think we are more in this situation right now, in this quadrant, and with inflation being around in US at 9.1% and inflation expected to come down, I think equities is expected to do well. Now, what is important is that whether inflation is rising or inflation is falling, one asset class which does the best is equities. So I think equity is a good hedge against inflation. Yes, it may not give a great return in a rising inflation, but it still gives a better return than any other asset class. Now, the last chart which I have for you is something very interesting. It talks about confidence in newspapers and TV news. So historically, it shows that what is the confidence of people on newspaper and television news. The green line shows the newspaper and the blue line shows the television news, and the data is since 1972. Now, if you look at the data in 1992, television news had almost 46%. People were having confidence in that, and newspapers were at around maybe 28 or 32%. Now we are seeing a significant decline, and the confidence is almost at a bottom. Only 11% of the people have confidence in the television news, and newspapers have only 16%. So it's a big challenge. I think the biggest challenge is from where to get the right information. A lot of time the newses are biased, or enough homework or research is not done. So it's a challenging thing. And we have a lot of data, we have social media, we have news channels, we have internet, which gives us a lot of information, a lot of data, but getting quality information which can help us in making better decisions is a challenge. But yes, as far as investments are concerned, finance is concerned, you can always rely on Alpha Capital to give you the right information. So that's all what we have today in this information, in this show. I hope you find it useful. Please share your valuable feedback with me at contact@alphacapital.in. If you have any queries, you can always reach out to me and I'll be always there. Thank you so much. Wishing you a lot of happiness. Thanks a lot. Bye.